On today's show, we have Jim Pfeifer, one of the founders of Left Field Investors and the host of the Passive Investing from Left Field podcast. Left Field Investors is a group dedicated to educating and assisting like-minded investors to negotiate the nuances of the passive investing landscape and world of syndications. I really love what Jim is doing in the community that he's building with Left Field Investors, really because it's bringing together like-minded people who want to diversify their portfolio and really come together in a community to just really learn best practices, learn who the best sponsors are. And so we really had a great conversation about what it looks like to invest alongside a community, the deals that him and his group are investing in, and what he kind of sees is the future of group investing. And so really great conversation. I think you're going to enjoy this one. If you haven't checked out Left Field Investors, make sure you do that as well. Enjoy the episode. Jim, welcome to the show, man.
Thanks for having me. I'm glad to be here.
Hey, so let's start. What the heck is Left Field Investors like, and where's the name come from? Let's start there.
Well, yeah, the name everyone thinks we're big baseball fans, and actually we're not baseball fans. But the way the name came about was I'm a former financial advisor, and when I was getting into real estate and what people call alternative investments, which again I don't like that name. But
let's talk about that in a minute, right? Yeah, let's come back to that, but keep going.
Yeah, my colleagues in financial advising always acted like I was way out in left field for doing these crazy alternative investments, and that's where we got the name. Just because we are out in left field, and so it's kind of evolved where we think of anybody who's investing in real estate and that kind of thing. You're in left field, and if you're in the stock market, you're in right field. And so we also call people in center field who have dipping toes in both sides. So that's kind of how the name came out, and it just kind of fits.
Yeah, I love that. Let's so Left Field is an investor community, which I think is really unique, strictly for kind of like passive investors, because there's a lot of communities, those who are maybe active in real estate, putting deals together. But what are the uniques when someone says, well, what does it look like to be involved with Left Field? Why, what are the uniques, and why did you focus on kind of this niche for your community?
Yeah, so I think what's unique about us is that we are strictly here to provide a network and education for people who are interested in passively investing in real estate syndications in order to generate wealth through cash flow and then appreciation on the backside. That's kind of our mission. And the reason that that's what we do is, to kind of take it back, the group started, I was switching from being an active investor to a passive investor, and I found that I had started a community for active investors, and it was super helpful to me. So as I was switching what I was doing, I thought, yeah, why don't I start another community? And the goal was just to have 12 people in Columbus, Ohio, where I live. We could go to dinner once a month and just share stories about passive investing. I didn't have an idea to have a large group. And our first meeting was March 18th, 2020. And, pandemic canceled everything, and we never met in person. But what that allowed us to do was start meeting on Zoom, which led to us being able to get guests to come, right? Like sponsors or different people that wouldn't have flown in just for a meeting with 12 people sitting around talking about investing. And so that allowed us to get some really great speakers, and the group kind of grew, and we kept trying to shrink the group and not allow people in. But then we realized that there's such a demand for this, for a kind of an unbiased community where we're not recommending sponsors, we're not GPs on deals, we're just a group that's trying to help each other learn how to become better investors. So it really grew. That's when we decided we needed a brand, a website. We started our own podcast. And so it's really grown from there.
I'm curious, man, since this is, we're talking about kind of the future in investing. I mean, why why did you kind of hone in on real estate syndication? That seems like that's important kind of core value, and that's a lot of what you're investing in. Talk to me about why you like real estate syndications, and even where you kind of see this industry going.
The reason syndications for me is because I was an active real estate investor, but I was active trying to be passive, right? I tried a bunch of different things. I did a house flip. That's obviously very active. I had some single family rentals. That's active or passive, depending on how you manage it. And I had property managers, so I was trying to make that passive. Then I got into multifamily, and I wanted to make that passive, but I had a property manager. So I was trying to make something passive that is inherently active, right? I was the asset manager. I had to manage the property managers, make sure they were doing all the right things with the properties. And I realized I wasn't very good at being an asset manager. And so when I found syndication investing, that is truly passive on the back end, right? There's active parts where you're evaluating a sponsor and the deal and all that. But once you wire your money, it's completely passive. And what I realized is I could get the same returns or even better returns from investing in somebody else, a full-time professional asset manager who's going to do all those things. They're going to get better returns because that's their profession, right? I was just trying to be an asset manager on the side while I was doing my day job. And I didn't commit enough to it. So I don't believe you can, at least I can't, I couldn't passively manage these active properties. And so I turned to syndications. My returns are better. At least the cash flow is better. And someone else is doing all the stuff that I'm not very good at. So it's kind of maximizing my strengths.
Right. Because as a passive investor, I mean, typically you're sitting in a pref position, right behind the debt. So you're actually typically getting paid before the sponsor gets paid. So the cash flow is typically, I mean, you're getting first dollars in terms of cash flow. So that makes a ton of sense. I want to ask you a couple questions because how many syndications are you in, Jim?
Well, it's hard to say only because I'm in a bunch on my own, and then I invest in groups through this company called TribeVest. And so that inflates the number of syndications, right? I'm in probably 60 to 80 syndications.
Holy cow.
But probably half of those are where I have a smaller interest because I'm partnering with a group of, because I'm in 6 different tribes, they call them at TribeVest. So I have 6 different LLCs that are groups of different people that invest together. So instead of putting 25,000 down for one deal, if I have a group of 5, I'm only putting 5,000 down. So it sounds more than it is. It's a lot of K1s for sure.
Right. So, by the way, Jim made a great intro to the CEO of TribeVest. So we're going to have him on really soon too. Really great company. I'm excited about that. So, wow. So we have a syndication pro, a passive investing pro, at least from experience standpoint. So thinking about the future, Jim, I want to ask this question because it's on my mind. I'm going to come back to some of the things you said. We are a syndication firm. I mean, right? We're a multifamily investment firm. And what I notice about this industry, and I feel like we've put a main focus on this because I just think real estate is a long-term asset. The goal is always for me, we need to turn money over instead of giving it back. We need to we don't want to pay taxes. That's always been, even before I learned about syndication, that always made sense to me. However, I find very few investors ask that question to sponsors, or even very few sponsors are thinking about kind of the 10, 20, 30-year vision. I'm curious on how important that is for you and your strategy, and even for you and your community, and even the way that maybe you make decisions around sponsors of not just the deal, Jim, but the future of the investment. Can you just talk maybe as an LP where that question comes up for you and kind of how you're thinking about that as a wealth building strategy, how you're actually using this? Or are you just, hey, I just want to see good returns in a deal?
Are you specifically talking about taxes, how we handle the tax situation? Or
yeah, well, I mean, are you in it for just the returns on this deal is going to give? Or do you also want to see that the company has a plan to maybe 1031 to protect, your investment from future tax liability?
Yeah, I am not, I shouldn't say I'm not a fan. I don't use 1031 exchanges.
Okay.
And let me explain what I do. I do what my accountant calls the lazy 1031. And it's funny that this comes up because I just wrote a blog on it and posted to our website yesterday, explaining what the lazy 1031 is. And it was the term was coined by my accountant. And so I had all these multifamily units, and I wanted out of the active passive thing that I talked about earlier. And so I sold all of those, and I had a big gain, right? Not because of anything I did, just the market was kind to me. And even though I mismanaged the assets, I had a gain. So I went to my accountant and I said, what do I do? We got to get rid of this tax burden. And he said 2 things. One I didn't like and one I did. The first thing he said is, Jim, sometimes when you make a bunch of money, you just got to suck it up and pay the taxes. And I was like, okay, what are you here for? That's not what I want to hear. And then he said, or you can do what I call lazy 1031. because I didn't want to do a regular 1031 because I was getting out of the active business. So I didn't want to upgrade into a new building, right? I didn't want to do the qualified opportunity zone had just come out, and I wasn't really interested in that because that's another long-term thing. But the lazy 1031, basically, he said, if you invest in these syndications that you're doing anyway, you can use the cost segregation bonus depreciation that you're going to get from making that investment, and that will offset the capital gain you have from selling your other investments. Now, the depreciation, on the other end, when you sell that asset, you're going to have to recapture that depreciation. But if you continually keep investing your proceeds or keep investing in these syndications, you're going to end up with a lot of passive loss that just stacks up, right? So it will offset most of the cash flow you get. And then when a deal goes full cycle, you can reinvest and you're going to offset the gain on that. So it ends up, what I call the lazy 1031, it's just using the depreciation and the cost segregation of your new investment to offset any gain that you're going to have from the old investment or from the cash flows.
Does that strategy change any over the next couple of years as the bonus depreciation incentive kind of drops? I think we're going to go down next year to 80, then 60, until we essentially phase it out. Does that strategy change at all as that moves?
Well, a little bit, but I've thought about this, right? So most of the depreciation you get when you first start investing, you don't have a lot of gains. So you end up stacking up a lot of loss. So I'm going to have a lot of loss that I've just been saving that I can use anytime. Number one, right? Number two, when they say the bonus depreciation is going from 100% to 80%, that's correct. You're losing that 20% in year one, but you still get that 20%, right? It's just going to be in a different year. So if you have what it does is if you have something that's depreciated on a 5-year schedule, this law allows you to put it all in year one. Well, how I'm looking at it is now if I can only do 80% in year one, I can still do 20% in year two. And when it goes to 60, then I can do 20% in year two and 20 in year three, right? So it's not like I'm losing the depreciation. It's just coming later. So as long as I'm continually reinvesting into new syndications, I'm going to continue racking up that depreciation. Mm-hmm. So I don't think it's going to make a huge difference, although I am investing as much as I can this year to rack up some more losses. And the other thing, a lot of people look at it and say, hey, you're just deferring because you're going to have all this depreciation recapture at the end. And I was talking to Tom Wheelwright, who's a well-known tax CPA for real estate investors. And his point is a lot of the bonus depreciation or even cost segregation, what that allows is you don't have recapture on something that's a 5-year depreciated part of the asset. If you're selling in year 5 or 6, right, that's all fully depreciated. So you don't have to recapture that. So the recapture is not going to be as big of a component as people think it is. So again, time will tell because it's going to take a while before you see if this strategy works. But I can tell you 3 years ago when I sold all those active investments, I didn't pay capital gains tax on my gains.
Because of the depreciation that you had on essentially from the cost segregation of your passive investing.
Right. Because in the year that I sold those, I took the proceeds and I invested it in syndications that I knew were doing cost segregation and bonus depreciation. So I purposefully invested that year in a bunch of stuff that would give me this depreciation. So I didn't need to 1031, but effectively I did, right? It's the same as a 1031. You have to keep upgrading. But the 1031 has all kinds of limitations, all kinds of complications because you have to find like-kind property, all that stuff. This, you just sell real estate and then buy some more and you let depreciation take care of the tax burden.
For those of you who are absolutely confused, let me see if I can sum this up. No, it's really good. And I'm really glad we're having this high-level conversation. I'll be quick. Whenever we purchase a property, let's say you're an LP into a deal, or you have ownership in a real estate deal, you get something at the end of the year. Typically actually comes in March because we can't get it to you that fast, but called a K1. And on that K1, it just shows your net income or net loss. And because real estate is a depreciable asset, typically, and we can do something in commercial real estate called a cost segregation, in many cases, if not majority of cases, you're showing a loss on that K1 statement, even if you got cash flow from the property. And that's what Jim is using to essentially offset his gains. It's a paper loss. It's not a real loss. It's a paper loss. And something about the tax code way above me allows you to use a paper loss to actually offset real gains, and that's how the rich continue to get wealthy, which is a beautiful thing. Let me ask you this: so you've been doing this for at least 3 years. In terms of, and you've seen this in. I mean, honestly, it's interesting. The syndication world is pretty new, right? I mean, 2012 is really when the Jobs Act got passed. Really, took a while for that even to come to fruition. So in some ways, it's a very new industry. The real estate industry is continuing to grow and change. I'm curious how your investment strategy has changed. Were you kind of strictly value add stuff? Have you changed that? Has it been just multifamily? Talk to me about your evolution as a passive investor into real estate syndications, as you've seen, one, this industry grow, and two, the real estate market change.
Yeah, I think, my strategy has changed a lot. And most of it was just based on me learning, right? The first few syndications I did, I didn't know what I was doing. I was just putting money places that sounded interesting, chasing the shiny object. I still chase the shiny object, but now I have a plan, I have a strategy. And basically that is diversification. I want to diversify by asset class, by sponsor, by market, maybe by type of debt. Anything I can do to kind of spread the risk is what I'm trying to do. So yeah, I love different asset classes. I'm in a bunch of different asset classes, and I'm looking at new asset classes all the time. But the key for me is the sponsor. You need quality sponsors. And that's what everyone wants to know, right? When they join our group or when they're talking, how do you find good sponsors? How do you find good sponsors? And that's where my strategy has evolved the most. I used to listen to podcasts, read books, search the internet for sponsors, and then I'd call them up and interview them and, have a 30-minute or an hour conversation to decide then whether I was going to invest with them or not. And that's hard, right? Because I'm having a 30-minute conversation with somebody or an hour, and then I'm deciding, okay, am I going to invest $50,000 with you? And that $50,000 is going to be out of my control completely for 3, 5, maybe 10 years, right? So how do I qualify a sponsor to make sure that they're working in my best interest? Well, it's very hard, right? There's only so much you can do. And so that's my main shift is now, because I'm part of a community, because I've built a network. The way I find sponsors now is I really only invest with somebody if they're referred to me by somebody I already know, like, and trust, who's already invested with that sponsor. Now, not only that, that's the main way, right? If they don't fit that qualification, if somebody that I know hasn't invested with them and I find a new sponsor, then I'm going to take a lot longer to get to know that person than 30 minutes or an hour. And I tell them up front, hey, I'm going to have this conversation with you, interested in what you're doing. Let me know what you're doing. And then I say, I'm interested, but you're going to have to send me a few deals, put me on your waiting list, and I might not invest with you for a year or two, because I want to see how you're doing, because it is such a long-term investment and it's completely out of my control. I cannot sell my shares. I'm stuck with that sponsor regardless. So, and that's another test, right? If the sponsor is someone I want to partner with, they will say, yeah, that's completely fine. If it's somebody that says, come on, you got to get in this deal, you got to get in this deal, well, that's an easy out for me, because there's hundreds and thousands of sponsors, and I don't need to do business with someone that isn't patient to wait and develop a relationship. So that's kind of my major evolution, is really honing in on finding quality sponsors in a systematic way.
What are the asset classes that you're really bullish on right now?
So I'm in, of course, multifamily. I like self-storage. I've had a couple of really good exits in that recently. I like mobile homes. I really like triple net. I'm in some commercial and some industrial triple net. And then the newest one that I've jumped in, and I don't know how it's going to go, but Bitcoin mining.
Okay.
I'm also very interested in data warehouses for either Bitcoin miners or just for, store servers and things like that. I haven't found syndicators doing that a whole lot, but that's what I'm looking out for, because I think that's something that would be interesting in the future, because there's such a need for that. But yeah, I'll look at any asset class, but it really matters who the sponsor is. And there's a few people who are kind of like syndicator aggregators, where they find new asset classes or find new sponsors, and then they do some deals with them just privately, and then they spread them out to their network once they're proven. And so I like hooking up with guys like that, people like that who, test something out, and then, I already know, like, and trust that person. So when they come up with a new deal, I'm likely to jump in it.
Right. Makes sense. Any trends across your community, Jim, that I don't know, things that if a passive investor is listening, that I don't know, core value. I mean, besides, I think sponsor is great, right? You bet on the jockey, not the horse, and is kind of the saying that I've heard a lot. But any other trends or things that maybe are common across your community that would be helpful for other passive investors to know?
Yeah, I think something that's becoming more popular, and if you Google it, it comes out controversial, but I'm using high cash value life insurance policies to fund your investments.
Hmm.
It's similar also to using a HELOC to fund your investment, right? So it's using lazy money to get a return from the same dollar in two places. So, for example, if I take $50,000 out of my cash value life insurance policy, that policy is going to perform the same as if the money was still in there. And I can take that out at a 5% simple interest loan. And I can take that 50 grand and invest it in something that's going to earn me, 8 or 10%. So I got a little arbitrage. And then the upside is that's the cash value or the cash on cash return. And then the upside is the appreciation you get on the backside. So 5 years later, I can pay that back. And I basically created cash or an asset out of nothing. And the same way you can do that with your HELOC. It's a lower interest rate, but you're not earning in two places, but you're borrowing at 3% and earning at 8%. So those are two things that are pretty common in our community right now.
Yeah, and important there is that you're investing in assets that have a yield and that are appreciating, right? I mean, and that's significant. And what he's saying is, I mean, and we had done the same thing actually, in that the life insurance continues to grow because you're not necessarily taking money from the asset or the life insurance policy. You're borrowing from the cash value at 5%. So the life insurance, which is an asset, can continue to appreciate, or your home, if you're doing a HELOC, can continue to appreciate, and you're essentially just borrowing off the equity or the cash that you have in the deal. So it's a really smart. I think it's brilliant, and I don't, I mean, think about equity in a home. I mean, here's the thing. I mean, it is controversial because we've been taught forever, that your home is your greatest asset, and why, now once you paid it off, why would you ever tap it? Well, I think people need to be reminded we are in the historical low interest rate environment. I mean, this was a little bit harder back in the 90s when maybe we had, you've seen this, Jim, right? When the interest rates were maybe in the teens, but man, we're talking about 2 or 3% interest rate, locked, fixed, where then you can go invest in an asset that can produce a double-digit return. That's almost seems not smart to not do that.
Well, yeah, and there's a couple other points to that, right? We're also having high inflation right now, so you want as much debt as you can because inflation is going to erode away that debt, right? So that's one thing. The other thing is if you have a fully paid off house, the equity in that house earns 0%, right? Because you're not the value of your house may go up, but that's going to be the same whether you have a loan on it or not. But the actual equity in that house earns nothing. So if you can take that equity out and start earning something on it, right, it makes complete sense. So from both of those aspects, you should be leveraging your house comfortably, right? You don't want to do anything that you can't sleep at night or makes you uncomfortable. But having equity in your house just doesn't make any sense.
Jim, how do you track 60 to 80 syndications, like in terms of performance, in terms of returns? That I think that's maybe something that can be developed in this space, right? As multiple people are doing different things, just kind of aggregating where you're at in your portfolio. Any tips?
Oh man, that's one of the holy grails, right? Is to develop something. So I have Excel spreadsheets that I used to use, but then that was one of the things I wanted to develop as part of Left Field Investors. We have a membership group called the Infield, and it's paid membership. But part of that, we have some tools, and one of those tools is we call it the Portfolio Tracker, and that's a web-based tool where you can put in all of your investments, all of your syndication investments. You put in the pro forma numbers, then you put in the actual numbers, and you can track and sort and search and see how you're doing. Now, this tool we developed last year, and it is in dire need of an upgrade because it's a very hard thing to put together. But that's one of our goals for 2022 is to really make this tool really useful. Because if you're tracking one or two investments, it's easy to figure out if your actuals meeting pro forma. But like you said, once you get to 5, 10, or 60, it's chaos. And right. I used to have a couple of Excel spreadsheets that were linked and we're talking to each other and going back and forth. But now I just use this online tool. And again, it needs improvement for sure, but it's the best thing I've seen out there. And we're trying to make improvements because you also want to track portfolio numbers like your cash on cash return, IRR, and things like that. And it just becomes super complicated. So we're working on it, and I'm hoping to have a pretty good solution. I think we have a fine solution now, but I'd like a good solution, and that's on the docket for 2022.
Yeah, no, I appreciate it, man. I appreciate your involvement in this space too. I think, there should be more of a partnership and kind of synergy between active and passive investors, because we need each other for this space to really grow and flourish in a big way. And it is, thinking about the numbers that are coming into private placement offerings, it's pretty massive, and almost doubling year over year at this point. And so, stuff like that really needs to be developed fast as more money comes into the space, and it will, right? As this kind of becomes common or more common, and more people understand that, hey, this is not a Ponzi scheme, or, like passive investing, syndication is actually somewhat, it's an incredible strategy. So
yeah.
What's the future of Left Field?
We're continuing to grow. I think what we're trying to do is figure out a way to support our community and develop more tools. 2022, I think, is the year of networking for our group, because what happens is when people join our group, a lot of them, you can sign up for a call with me. So I talk to 2 or 3 new members every day, and that's great for me. But what I want is our members to be talking to each other, right? So it's not just me that's meeting everybody, but everybody's meeting everybody. Right. So we put in a couple of things in place this year. One is we have this thing called Intros. It's just an app where you sign up, and every Monday you get an email that says, would you like to participate? And if you say yes, it'll match you up with somebody else in our group and schedule a time where you guys can just have a phone call. Huh. So that allows people in our network to talk. The other thing we're doing is we call these our mound visits, keeping on the baseball theme. But we're having informal meetings with no agenda. So and we have 5 founders. So each of our founders does one, once every week or 2. And it's either in Clubhouse or this app called Wonder Me. And it's just basically trying to get as many people from our infield community together, just have conversations with no agenda. So you're talking, like we had one last night, ended up talking a lot about one of the founders who took his 401k and paid the taxes and penalty and released the money and was able to invest it in syndication. So we had a huge conversation about that, because networking is hard because we have monthly meetings, but they're a Zoom, and after Zoom, we kind of try breakout rooms, and it's just difficult. So we're trying to make networking easier, because I cannot overemphasize the value of community, of learning from other people, of meeting for other people. And we have a forum. There's a lot of people, posting stuff on our forum all the time, but to actually have conversations with people, that's where the learning happens. And that's where helping each other happens. So 2022 is where we're trying to build out ways for our community to meet each other and talk to each other.
And I think you're so right on too, right? In that, like we just said, this, from a time perspective, is a new space. There's just not enough written, or not enough even tested yet, to be able to go out. You're not going to go to a financial advisor and learn any of this. And so it must happen kind of in a private, group community aspect like this. And so, Jim, with that said, where do folks go, man, to learn about Left Field or be involved with what you guys are building?
You can go to leftfieldinvestors.com, and there is a button in the top right that says subscribe, and that'll get you on our email list. There's also in the top right, there's a button that says masterclass. We have a masterclass, which is basically an introduction to syndications, passive investing, talks about how to find a deal, vet a sponsor, all that stuff. And then if you'd like to contact me directly, you can do that at jim@leftfieldinvestors.com. And you can, on the website also, you can schedule a call if you want to chat with me. That's what I do all day is chat with people. So feel free to reach out.
Good deal. Jim, any predictions, man, about the future of real estate? Let's talk about real quick. Just want to get your final predictions before we get out of here today. 2022, we're sitting here in January 2023. Let's talk about you said you're big in multifamily. You think cap rates are lower or higher at a year from now in multifamily commercial real estate?
Well, that's an impossible question to answer. And what I'm going to say is I don't really care as long as my stuff's cash flowing. I'm I know you got to look at cap rates and you have to understand all that stuff. But for me, I'm a cash flow investor. So I invest in cash flowing assets and I expect them to continue cash flowing regardless of what cap rates do.
Great answer. So we're great way to not answer the question. Yeah, nice job.
Yeah. Or I could just say I have no idea, which is also the truth.
Yeah, for sure. Like everyone. All right, man. I appreciate you. Thanks for coming on today.
Thank you. Had a good time.